Hi guys, welcome back to the channel. So today we're going to talk about the great market rotation that's happening in the stock market right now and what are the action that I'm taking and what you can possibly do as an investor. So if you're investing in these uncertain markets, let's dive straight into it. Okay, so right now the big issue that a lot of people are talking about is this whole great rotation. So what is this great rotation? Basically, the whole of this year, right, year to date, you can see that mainly the sector is dominating is the communication and services, right, the technology sector, right. These are the main sectors that did really well in 2024. In fact, if you look at the S&P 500, right, which is over here, SPX, okay, right, it has gone up 17% as of recording. Now, if you just take a different weightage of the index, for example, the RSP. So what is RSP? Is the equal weighted S&P 500. Okay, so if you compare the two, if we take away the top weightage in the S&P 500 and we just take the equal weightage, right, suddenly the return from 17% dropped down to 7%. So you will lose more than half of your return. Okay, and that's why this year, anybody who bought tech, like your Nvidia, Microsoft, all these, right, they suddenly feel very smart. They suddenly feel like, hey, wow, I'm an investing genius. Okay, so and that's when the stock market god will come and wake you up. Okay, so what we experienced in the last couple of weeks is that there was a very major pullback. Okay, so you can see here the largest companies like your tech companies like Microsoft, Nvidia, Amazon as well are pulling back, whereas the gains are moving towards the non-tech sectors. Over here you can see healthcare, industrial, real estates, right? Now, what is the reason of this happening is because previously the tech sector seems to be the safest area for people to invest in the high interest rate environment, right? Because even with high interest rate, the tech businesses like Meta, Apple, Microsoft, they can still charge high prices and maintain that revenue, maintain that earnings. But right now, what we see is that Jerome Powell and the Federal Reserve are giving us some hint that interest rates are starting to come down, right? And when that happens, guess what? The attention now rotates to what we call interest rate sensitive sector, right? So this includes your utilities, your real estates, right? Or even some parts of your consumer defensive. These are all interest rate sensitive area. High interest rate, they tend not to do so well, but if the interest rate is going to come down, that's where investor will front run the whole thing and say, hey, let me just diversify some of my investment into this industry. And the main reason why Jerome Powell says that they are likely going to drop interest rate is because the inflation number seems to be coming down. Okay, so you can see this chart over here. We used to have really high year-on-year inflation numbers, right? As high as close to 7-8%. But right now we are at 3%, right? It dropped down to 3% in June when the expectation was 3.1. Okay, so inflation is coming down much faster than expected. And Jerome Powell already said before that the central bank will need to cut rates before the inflation goes down to 2%. That means don't have to wait for inflation to reach 2% before they cut. They will start cutting as it starts to drop down to ensure that inflation doesn't drop too fast and too low. Okay, now when is this cut going to be? Right now, the next FOMC is in 8 days, right? I don't think they're going to cut this round. In fact, the probability of them cutting is going to be in September, right? Over here, the article actually says that the odds of it happening is at about 100%. Once again, with the interest rate coming down, interest rate sensitive sectors will start to fly. For example, real estate and consumer goods. Okay, you can see that in the last 1 week, for example, you can see that consumer staples went up by 1.4%, real estate went up by 1.87%, utilities went up by 1.7%. Whereas the tech sector went down by 3%, your consumer services, which includes your software services, went down by 1.33%. This is something that is happening right now, and a lot of people call it the big rotation. And the rotation is not just into different sectors, it's also rotating between sizes. Okay, so previously, there are a lot of attention in the mega caps, right? So which is once again your Amazon, Google, the trillion-dollar companies. But right now, we are seeing that the small caps are catching up, right? So you can see, actually, if we take the last couple of months, actually the small cap index has outperformed the NASDAQ. So what should we do over here? Now, before you decide to do anything, let me just go through some of the important economic activities going to happen, right? So over here, you can see that existing home sales is coming out, PMIs are coming out. So this actually will give you an indication whether the sales are going to be good and whether the manufacturing pace is going to be really good. Okay. The next one I want to watch quite carefully is the new home sales. I want to know whether people are buying new homes. Okay. And the more important one is actually the GDP and initial job loss. This is something that tends to swing the market a lot. If you look at the past GDP figures and initial job loss, right, it has a biggest impact in the market in the short term. Overall, how do we look at this? Very simple. Right now, the market is very weird. Okay, if you get poor GDP results and more people getting jobless, right, that means poorer economic activities, the market is going to go up. Why? Because that just gives them more confidence that Jerome Powell is going to start cutting rates, okay, by September. And finally, this week is super important because by Friday, we will see PCE and the core PCE, which is actually Jerome Powell's and the Federal Reserve main yardstick in terms of measuring inflation over here. Okay, now let's go and look at investor sentiment, right? Right now, we are kind of like a little bit greedy, okay, slightly greedy. Why do I say slightly? Because we are at 56 points, right? So it's just slightly above the neutral zone. But previously, about 1 month ago and 2 months ago, we were actually in the fear and neutral zone as well. Okay, so this is kind of like somewhere in the middle, not very reflective. Usually, I will be more happy that the market is going to go up when there's a lot of fear. Okay, and when the sentiment is super greedy, like about a year ago, right, 81 points, that's where I get a bit scared. Okay, so last year when it was super greedy, then I try to pull back some of my investment because the sentiment tends to be opposite of what the market will do. In fact, we always say that the general sentiment is always wrong. Why is that the case? Because if the whole market is correct, then where's money going to come from? Okay, ultimately the stock market, in a certain sense, is a zero-sum game over here. Okay, now another website asked a really good question to a poll of people. I think this was more than 2,000 people. They asked them, how would you describe the current valuation of stocks? And I wanted to use this as a sentiment as well, right? And right now, actually the sentiment is kind of mixed, right? So the majority over 44% says that valuation are mixed. Some stocks are expensive, others are cheap, okay? But there are quite a number, 36%, right? Saying that the stocks are overvalued. So right now, we do see that the sentiment is that things are doing well, but really overvalued over here. Now, if you go to the main index, the S&P 500, you can see right now, we are kind of having a mini pullback to this support level, which is really healthy, okay? So guys out there, if you are really worried about this kind of pullback, right, you really need to look at yourself and ask yourself why, okay? The stock market is a pricing machine. It is telling you that right now, the US market is cheaper than where it was a couple of days or even weeks ago, okay? So if you go to the shopping mall, right, you wouldn't complain if the price is cheaper, right? But in the stock market, that is what is happening, okay? And we do welcome this kind of pullback, right? Even the pullback in March and April was much bigger, much more dramatic, okay? So the recent pullback shouldn't give you too much worry. In fact, this is welcome because we don't expect the price to shoot up like that, okay? Indefinitely, this is not possible, right? Now, if you look at NASDAQ has a really nice pullback back down to the 50 moving average. I love it. You look at the MACD, looks good. The RSI, still much to be desired, but close enough. But the stochastic is really good. Okay, the last time we had a very low stochastic like this, we were actually at the bottom, right smack at the bottom. Okay, which is why right now I'm starting to crawl back into the market, starting to reinvest again. Okay, and of course the story of the town is actually CrowdStrike, right? CrowdStrike had a worldwide outage. Okay, and the price has dropped more than 30+%. Now, the question that I get posted a lot is, hey Pete, is this a good investment? Should we go buy into it right now? I would say not looking at the technicals, but you should look at how is the business, right? How is the business doing? Okay, so over here, let me just swing very quickly to look at how is CrowdStrike doing, and looking at it from the fundamental analysis angle, right? To understand that is this a great business. Okay, so I like to use this website called Stock Analysis. Another website I like to use is ticker.com. Okay, so let's just use Stock Analysis for this one. And I just want you to take a look at in terms of their growth, right? It's a fantastic business, right? The income is also increasing quite nicely, quite well. In fact, only the last year it started to get positive income. Okay, so that's pretty good, right? Balance sheet wise, if you look down over here, you can see that their total debt isn't too crazy, right? In fact, this is a net cash business, right? They have more cash than they have in debt. And I like to look at cash flow. If you look at cash flow, the operating cash flow has been doing very well, increasing, right? On a very fast clip, over 20% year on year, okay? And if you look at the free cash flow, it's even faster at about 30+%. So overall, I would say the business is a pretty strong one, right? Quite a solid one. But one thing is when I look at the valuation, that's when it gives me a pause. Okay. So for example, if you look at valuations, now I know a lot of people out there like do DCF. I'm not a very big fan of DCF because it's a very precise tool that has the problem of rubbish in, rubbish out, right? Imagine you just change your weighted average a little bit, you just change your growth rate a little bit, your whole valuation number will change. So what I like to use is what I call a relative valuation. Okay, I just want to see that, hey, compared to the past or compared to common sense, is it very overvalued? For example, a PE ratio is 500. Whoa, that's quite high, okay? Right? If I look at price to book ratio, in the past, the price to book ratio, actually when you look at it, actually 25 is not so bad. It is still pretty decent, okay? You can just take your cursor over there. You can see price to book ratio over here, okay? And in fact, if you look at EV, EBIT, okay, it's starting to come down, right? So overall, I would say if you look at price to book and other ratios, right, it's still not cheap. It's still not cheap. That's number one. Number two is this. This is a business that while the growth is happening, it is not a very efficient business. Okay, so that's one part that I don't like it. ROE is 6% only. ROA is only 2%. Very, very low efficiency business. So overall, I think to me, CrowdStrike is still a bit expensive. I wouldn't be touching it as of now, right? And the thing is, I want to consider, hey, do I want to include some of the small cap stocks over here? So what can we do right now? Now, for me personally, I'm looking at including some of this smaller cap, right, interest rate sensitive sector into my portfolio. Okay, so I did a bit of research. Very easily, you can include them using ETF, right? So for those of you who don't know what an ETF is an exchange traded fund. Basically, each of these funds holds a variety of such stocks, right? So over here, these are some of the ETF that you can have a look, right? For example, these are all the iShares Russell 2000 ETF. Now, Russell 2000 is basically the small cap ETF and they hold 2000 stocks, so you are very diversified. So the standard one is actually here IWM. IWO is the growth segment of these 2000 stocks, right? They only include the growth stocks, and IWN is the value ETF of this one. Okay, so I think these are some stocks that you can potentially consider. Now, how to react going from here, from this whole rotation, right? While I talk about having small cap ETF, the question is, should you sell the tech businesses and buy these instead immediately? I would say the answer is no, right? Because you still need to think about, hey, what is your broader plan? That's why investment is so unique, right? That it doesn't mean that one person's plan can apply to the other. There's no one size fit all over here. Okay, so what I would say is that yes, for those of you who want to diversify, you can, but just remember that you want to diversify into those segments that you can be comfortable with, right? Warren Buffett or Charlie Munger said this before, that you don't just diversify. If you diversify without knowledge, you are actually diversifying your portfolio. And that's not what we want to do over here. Okay, so do make sure that if you're diversify into certain sectors that you have confidence about, right? So it's not to include everything under the sun like a salad, but you just want to make sure that you invest in a particular industry, right? And include other industry that you're confident about to diversify within your circle of competence in the knowledge segment. Okay, so personally what I'm doing is that I am diversifying a little bit into all these ETF, but overall, I still think that some of these tech businesses are doing really well, and I'm just waiting for them to retrace, right? Because some of them are pretty overvalued. But right now, are there opportunity out there? The answer is yes. Okay, so I'm going to share with you some of the stocks that I do see a little bit of opportunity coming up. For example, ASML, right? So this is the world's largest chip machine maker. Okay, so not the chip maker itself, but they make the machine that make the chip. Okay, I know it's a bit complicated, but ASML has been a fantastic stock, right? In fact, if you look at 1 year, it has gone up by 42% already, and right now it is at a very nice 200 moving average over here. Okay, if you look on a weekly basis, it has pulled back all the way, one straight line back, right, to the 50-week moving average. So pretty good, right? The chart here looks solid here. Now the next one I will share with you is actually the sister of Nvidia. Okay, so AMD over here. AMD has fallen down to the 200-day moving average, which is usually a very strong support. You can see in the past, right? It has been a very strong support. So I really like this. The TA is still a bit weak. For example, MACD is not great yet. RSI still got a little bit more to go. But stochastics is strong, right? The William R is strong, right? So you can see over here, the last time that these two indicators visited here, we were at a very nice support as well, right? So I like this. Now, Any other companies, for example, Amazon, right? One of your mega 7, right? At a very nice 100 moving average. The TA over here all score great scores. Definitely this one, I'm looking at entering it myself. Arista Network, one of the beneficiaries of all these AI segments, right? 50 moving average. Very strong. The last time I talked about Arista Networks in my previous live update was actually back in May, right? You can see we did over here, and right now, I think it was around 290, right? It has already gone up to 340. So that is more than a 10% gain already. So for those of you who watched the last live update, congratulations. Okay. Next one, Broadcom, another semicon segment, back to the 50 moving average as well. Now, I talk about Broadcom over here, it's not just because the TA looks great, but it is a business that is essential. And I repeat again, essential for the AI industry to proceed. Because while it is not a chip maker, but what Broadcom does is it provides a lot of the peripherals, a lot of support systems that makes all these data centers and AI possible, right? So this is going to be quite a big one that many people may not be looking at it just yet. Okay. Now, another one that I mentioned before is actually Coca-Cola Consolidated. Okay, so for those of you who suddenly look at it and say, why is Coke share so expensive? No, this is not the drinks Coca-Cola. This is the bottler, right? So these are the companies that bottle Coke drinks, right? So they are called Coca-Cola Consolidated. Now, I know the per share price is really high, but once again, the share price does not mean whether it's cheap or expensive, okay? A high share price just means there are fewer shares for the same company, and the low share price just means they produce a lot more shares. That's all, right? It doesn't mean they're overvalued. For me, I like this company. It's a brick and mortar business, and they have been producing very, very good results, right? In fact, you can see in the last earnings call, they did so well, there was a massive jump, and their earnings are coming up pretty soon, okay? So I like the fact that it's consolidating here at the 20 EMA moving average. It is not really, as good as some of the tech companies, but this is a company that you can see in the recent dip, right? In the stock market, it was pretty much unaffected. So I like to keep some of these bellwether companies, right, in my stock portfolio. Okay. Let me show you another one, which is Alphabet. I think this one shouldn't be a surprise. This is at a 50-day moving average. Very nice MACD, stochastics, and various RSI over here. Okay. Just show you one more. Meta. Meta is kind of at an in-between. Not clear whether this is a support, but last time it did jump around this period. Okay. The various stochastics indicators are really good. Okay. Microsoft as well, similarly coming down to the 100-day moving average. I like the setup here. And last but not least, Nvidia. Okay, the one that everyone talk about. Is over here at the 50-day moving average, and it has since bounced up already, right? So I really like what I'm seeing here, okay, in terms of technical indicators, right? So these are generally the main companies. Technical wise looks pretty good, right? I'm also researching more stocks also, right? So for those of you who want to keep updated with my movement and my research, okay, on my stock market analysis, right? You can join my free newsletter. That's where I talk about my analysis in the stock market. I don't really talk about property over there. I do talk about property in this channel because I want to keep that newsletter purely towards stock market investing. Okay, so stock market investing and property investing, to me, these are perfect marriages, because property investing is one that is more stable, right? So I don't need to look at it every single day, and it provides me that stability in my portfolio, whereas the stock market gives me that volatility. It does go down, but hey, it does go up really much as well, right? So it provides that upside swing, right, when it does really well. And I like how it complements each other. Okay, so you want me to share more about these two, how I manage as a portfolio, do put down in the comments. And once again, join my free newsletter over here. I'm going to put a link here and in the description. All right, so once again, if you like the content over here, do like and subscribe, and I'll see you guys next time.